Thinking of exiting your business or taking on a private equity partner to help you grow faster? BizNexus has you covered. Tap into our network of thousands of best-fit investors, acquirers, and proven M&A advisors, and we'll help you begin the relationship confidentially on your terms, your timeline. Learn more at biznexus.com.
Disclaimer from the always present legal team: podcast conversations don't necessarily reflect the views of BizNexus Incorporated. Everything you hear is informational news and updates from around the industry. We're not recommending any investments. We're not offering any investment advice. Be sure to do your own homework.
Welcome back to the deep dive. Today we are heading into what you might call the engine room of M&A.
Right. The part that generates a ton of volume, but it rarely grabs the big headlines.
Exactly. We're diving into the lower middle market, or, the LMM.
And just so we're all on the same page.
Yeah, let's define that. For this deep dive, when we say LMM, we are talking about private M&A deals where the transaction value is $50 million or less.
$50 million or less.
And you might think, okay, that's small, but you really shouldn't. These deals make up more than 40% of the total M&A deal volume out there.
That's a huge slice of the pie. This is where the real foundation of the economy is, bought and sold.
It's the whole growth pyramid.
It is. And thanks to the material you shared, specifically the SRS Acquiom Dalton Thacker 2025 M&A Deal Terms Study, our mission today is pretty clear.
Okay, what are we looking for?
We need to pull out the specific nuances. Where exactly do these LMM deals differ from the broader market? The big idea we're testing is that these deals are just as complex, maybe even more so, than the jumbo ones.
But they solve that complexity differently.
Precisely. Using, you could say, more customized, almost old-school financial engineering.
Okay, let's unpack this. If we're talking structure, we have to start with who's buying these companies and, maybe more importantly, how they're paying for them. The first thing that really jumps out from the SRS Acquiom Dalton Thacker data is the appetite of strategic buyers.
Unwavering is the word.
Yeah, unwavering. These are your U.S. public or U.S. private companies, the ones that aren't PE-backed, and they are just consistently buying up competitors or new tech.
And the numbers back that up.
They do. 55% of LMM deals in 2024. That's a huge majority.
It is, and that strategic dominance really influences everything else we're going to talk about. But we can't just ignore the rise of private equity.
Right.
PE firms and their portfolio companies, they've been getting more and more acquisitive in this space. They're looking for those add-ons.
Smaller firms, they can just fold into a bigger company they already own.
Exactly. And what that tells you is there's some serious competition happening between the pure strategics and the PE-backed strategics.
That's a really important dynamic. So does that focus on strategic buyers affect the geographical scope? I noticed something different here.
It absolutely does. The LMM is overwhelmingly domestic. You just see far fewer non-U.S. buyers in this segment.
Why is that?
Well, you have to think about the friction. For a deal under $50 million, the hassle of cross-border taxes, international regulations, currency risk, it just might not be worth it.
So the cost of the complexity just outweighs the value of the deal.
Unless that target has some truly unique global IP, it's just cheaper and faster to stay home.
That makes perfect sense. So let's pivot from geography to the money itself. How does this strategic dominance affect the way deals are paid for, the consideration mix?
It creates this really stark contrast with the rest of the market.
How so?
Well, broadly speaking, the M&A world saw a nearly 5% increase in all-cash deals. A lot of cash, a lot of certainty.
Okay.
But in the LMM, we saw the opposite, a nearly 3% decrease in all-cash deals.
So where's the money coming from?
Equity. LMM deals use buyer equity as part of the payment, about 22% more often than larger deals.
22%. Wow. What does that actually mean for the seller, taking stock instead of just cash?
It means they're taking a piece of paper, basically. It might be equity in a PE platform or in the larger strategic buyer. It means their ultimate payout is tied to the future success of the buyer.
Not just the company they sold.
Exactly. That's a huge distinction. It says a lot about, well, either their confidence in the buyer or maybe their lack of leverage to demand all cash.
But there's a little twist in there, right?
Yep.
The very smallest deals.
Yes. The deals under $25 million. They actually bucked the trend and saw a slight increase in all-cash deals.
So that push for equity is really concentrated in that $25 to $50 million band.
Precisely. That $25 million line seems to be where a deal gets big enough to attract those more complex strategic roll-ups, where giving equity makes structural sense.
Okay, here's where it gets really interesting, where that customization you mentioned starts to shine. Contingent payments, specifically earnouts.
Ah, the earnout,
Yeah.
the ultimate valuation bridge.
For anyone who doesn't live and breathe this stuff, can you give a quick definition?
Sure, it's basically a way for a buyer to pay less upfront with a promise of more money later if the company they bought hits certain performance targets.
And LMM deals are much more likely to have one.
They are. It reflects uncertainty, or big gaps in what the buyer and seller think the company is worth.
We expected that, but the sheer size of them is, well, it's astonishing.
It is. In 2023, the potential earnout on an LMM deal was more than 50% bigger as a percentage of the closing payment compared to the broader market.
50% bigger. That is a massive amount of risk for the seller to take on.
It signals a profound level of uncertainty being baked right into the deal. When potentially half your payout is up in the air, you either have extreme confidence in your future performance or the buyer is just deeply uncomfortable with your past financials.
So if the risk is that high, what are they measuring? Are they using sophisticated metrics like EBITDA?
You'd think so, but no. Surprisingly not. The data shows a huge preference for top-line metrics.
Meaning revenue.
Right. 63% of LMM earnouts use a revenue metric. Only 9% use earnings or EBITDA.
9%? Why so low? That seems, well, it seems financially unsophisticated.
It's less about a negotiation tactic and more about just accommodating the target company's reality.
What do you mean?
Think about it. A lot of these companies are run by brilliant entrepreneurs, not professional CFOs. Their internal systems are great for tracking sales, but asking them to calculate a GAAP-compliant EBITDA post-close, it's just not what the system's built for.
So they default to the simplest measure they have.
Exactly. Revenue. It becomes a structural necessity, not really a choice.
I did see some shifts that looked more seller-friendly, though. A big drop in those EBITDA-based metrics and shorter performance periods.
Those are definite wins for the seller, for sure. Shorter lock-in, simpler measurement. And yet, if you look at the smallest deals again, the ones under $25 million,
Let me guess, there's a catch.
there's always a catch. They might get those better terms, but they still have a higher percentage of their total payment tied up in that earnout. So they win on the terms, but they lose on the certainty.
Okay, so let's talk about protecting that value. This is where LMM deals really diverge from the big ones. You might think smaller deal, fewer protections, but it's the opposite.
It is absolutely the opposite. Protections are ironclad, non-negotiable. Every single LMM deal that closed in 2024 included an escrow or a holdback.
And just to define those for the listener?
Right. An escrow is basically a pile of cash held by a third party after closing, just in case something goes wrong. A holdback is similar, but the buyer holds onto the cash themselves. It's the buyer's main recourse.
And the size of that escrow?
The median is 10% of the transaction value, which is actually the standard across all of M&A. So small deals, but a standard size risk pool.
And a longer risk window.
A longer risk window. The median survival period, that's the time the buyer has to make a claim, is 15 months.
That's up from the typical 12 months we see everywhere else.
It is.
So why does that extra 3 months matter so much? What does it say about the due diligence process?
That 15-month period is the structural proof of buyer discomfort. It tells you that even after doing their homework, the lower financial sophistication of the target means the buyer feels they need more time.
More time to find any skeletons in the closet.
Exactly. They are basically buying insurance against messy records. And we see that same caution with purchase price adjustments or PPAs. They're in 90% of LMM deals, and the escrow set aside for them is bigger too.
Higher escrows, longer periods.
It all comes down to leverage.
This heavy reliance on escrows and holdbacks points us right to the RWI divide.
Yes. Reps and Warranties Insurance. The tool that lets sellers in big deals walk away clean.
But not here.
Almost never here. In the LMM, RWI is nearly non-existent. For deals up to $25 million, it was only used in 10% of deals last year.
And that's just a math problem, right?
It's a fundamental math problem. The premium for RWI, which can be hundreds of thousands of dollars, is just too expensive relative to the deal size. So you default back to the seller-funded mechanism.
That 10% escrow.
That 10% escrow. The buyer is effectively saying, we can't get insurance from an insurer, So we're going to use your money as our insurance. It forces the whole deal structure to be more dependent on the seller.
And much more customized.
Exactly. And that SRS Acquiom Dalton-Thacker data shows that even when RWI is used in this space, claims often take longer to resolve anyway. So you're facing a potentially messy post-closing period no matter what.
Is there any other evidence of this complexity?
There is, actually. It's subtle, but it's the post-closing expense fund. It's money the seller set aside, totally separate from the escrow, just to pay lawyers to defend against future claims. It's an explicit admission that this could all end up in a fight.
And the amounts are not trivial for these sellers. $50,000 on the low end, up to $100,000. That's proof that the legal complexity doesn't just shrink with the price tag.
Not at all. And if we look at the structure of the deals themselves, we saw fewer asset purchases in 2024.
Which is a sign of what?
Less distress. Asset purchases are often used in distressed deals, so the buyer can leave liabilities behind. A decline suggests the LMM in 2024 was healthier, driven more by strategy than by distress.
So if we pull all this together, the equity, the huge earnouts, the mandatory escrows, the long survival periods, the lack of RWI, what's the final definitive takeaway for you?
The ultimate conclusion is that size does not equal simplicity, not in M&A. LMM deals are incredibly complex. They need these very specific, customized mechanics, not because the parties want them, but because they have to use them.
To compensate for other factors?
Right. To compensate for the target's financial immaturity and the lack of access to tools like RWI. The whole process is anything but simple. It's highly structured, it's often buyer favorable, and it means managing risk long after the deal is supposedly done.
So what does all this mean for you, the listener? I think the biggest lesson is that when you see an announcement for a smaller M&A deal, the closing date isn't the end of the story.
Not even close.
The real financial management of that deal, it begins after closing. The oversight required is just so much more involved than the size might suggest.
Absolutely. And if we can leave you with one final thought to mull over.
Please.
Given this reliance on escrows and holdbacks, which are just forms of self-insurance, what does that consistent median 15-month survival period really tell us about due diligence comfort?
Right.
If buyers consistently feel they need 3 extra months beyond the traditional year to find a problem, it really makes you question the true efficiency and quality control in the fastest growing part of the entire M&A market.
Some real food for thought. Thank you for joining us for the deep dive. We'll catch you next time.
Acquiring a business? BizNexus simplifies it. Access thousands of updated opportunities in our DIY marketplace or supercharge team sourcing with OmniSource, your all-in-one platform for on-market, off-market, and coming-soon deals. Scale smarter today. Learn more or book a demo at www.biznexus.com.